slow process of getting unemployment down.
The rate of change back to normal under wide debate. Dr. Hooper at Deutsche Bank, a wonderful conversation the other day. Let me review. He says no vaccine, no stimulus, recession Q4 into Q1. There are trenchant moments across any week of Bloomberg surveillance, and without question, was it a week ago or 2 weeks ago, Mark Zandi stopped traffic of Moody's with a statement on what the real unemployment rate is. It is in huge agreement with our audience on radio and TV. We got a massive response to Dr. Zandi's estimation that 10% is really 11 and even out towards 14%. He joins us again on this important claims day. What will claims confirm today, Dr. Zandi?
Well, the labor market's still struggling. We'll get about a million state regular UI claims and then another 500,000 in pandemic UI claims. Those are claims by folks that are gig workers and self-employed. So, and I think Peter Hooper's right. I think if we don't get another rescue package here, certainly by the end of September, we're probably going back into recession.
Mark Zandi, what does that mean in terms of what peak unemployment will look like?
Well, peak unemployment, we've seen that. I mean, appropriately measured, the peak unemployment rate was back in April when businesses were all shut down. We got close to 20%. Now we're sitting here officially at 10. My sense is that if we get a rescue package that's of reasonable size and reasonably well designed, and I'm still expecting that, we'll probably end the year with an unemployment rate somewhere around 9.5%. If we don't get a package, then we're headed north. Hard to imagine we get back to 20%, but we're headed higher. We'll stay in double-digit unemployment probably all the way through 2021. Wow. You know, I'd go so far as to say that this period that we're in will probably go down in history as a depression. If we suffer double-digit unemployment for more than a year, in my book, that's a depression.
That I just want to let that set in, because the idea
elasticities of wages now are radically different than what you and I studied in the book, radically different than Samuelson 1948, radically different than the classic studies of the United Kingdom in their lengthy depression. What is the elasticity, the responsiveness of wages given these challenges?
Well, when you have such high unemployment, they're not responsive. There's so many folks out looking for work. Very difficult to get wage growth of any consequence. I mean, we saw that, you know, in the expansion coming out of the financial crisis. It wasn't really until the very end of that expansion, you know, before the pandemic, that the labor market was tight enough that we were starting to get more wage growth that was more consistent with, you know, what we'd expect. So, you know, given we're in store, even if we get a
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Looking for a continued improvement in the economy, but the pace will probably slow down now that we've had this quick rebound.
If we don't get it, we're looking at the possibility of a double-dip recession, Q4, Q1, and further negatives on wage inflation.
They're going to keep rates at zero for a really long time, maybe forever.
This is a secular downtrend in the dollar that could be 10, 15, 20% over a 2-year period.
There is a certain logic in the market doing better than the economy here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast. Good morning on Bloomberg Radio, coast to coast. A special good morning on Sirius XM, channel 119, in the path of Hurricane Laura. That will be a long path of rain over the next number of days. Lisa Abramowitz, a natural disaster, and every expert we've talked to says, not that it will affect national GDP, but nevertheless, this is a profound storm.
Yeah, and it really raises a question of what resources the United States has to deal with a storm of this magnitude, the biggest storm hitting the U.S. in records going back to the 1800s. How much we have to combat this at a time of such economic distress?
Galveston here, I believe, in the sunrise across Galveston over to Lake Charles and on to New Orleans. The path really centered right on the Louisiana western border and the eastern Texas border as well. Landfall was 150 miles an hour, was scoped back to 1856. The landfall of the jobless claims here, Lisa Abramowitz, in 29 minutes, make it 28 minutes. We're benumbed by 1 million a week.
I don't understand the relationship right now between the economic data and markets. We're at record highs for the S&P and NASDAQ, a little off that in futures this morning if it continues through the market open. And yet we're expecting the 23rd out of 24 weeks of unemployment claims at 1 million or above.
It'll be interesting to see as well, Lisa, on Jackson Hole. And of course, we're going to really spend a huge amount of the hour here looking at the economics that Jerome Powell confronts. But Lisa, what I find fascinating here is if he disappoints, the abruptness in the yield market will be extraordinary.
What does disappointing mean, right? I mean, the expectation...
I think it says nothing.
Yeah, I mean, the expectation is that he'll come out and he'll lay the expectation for interest rates to remain at zero for at least 5 years, read infinity, that they're ready to step in with any additional programs. What else can they say? That they're going to take rates negative, that they're going to buy more junk bonds? I mean, basically, people are assuming that's on the table anyway, depending on economic conditions.
Well, we're thrilled you're with us on this simulcast on economics, investment, and finance as well. I'll get it out there. It's in there somewhere. I'm like this, folks. Economics, finance, investment, a lot going on. Michael McKee will be with us. Megan Green is scheduled to join. But with futures at -8, Dow futures -71, with down 28,000. Salesforce.com entering the Dow. Alicia Levine joins. She's the BNY Mellon. We're thrilled she could be with us today. Alicia, the last time we spoke, I believe you had a more conservative tack, a more caution to the equity markets. Do you sustain that?
So, hi, good morning. Nice to see you guys again. I mean, look, I think that the pace at which we're rising is a little bit concerning for future gains from here. But overall, there's so much support in the market, not just from the Fed, but also the flows year to date, where 5-to-1 flows have been going into the bond market and not equities. And also the fact there's nearly $5 trillion on the sidelines sitting in cash. And so all this suggests there's still dry powder, even with the pace at which we've moved higher. So yes, I'm cautious. We're just going into that season, that seasonal sort of weakness, that September, October, where, gains tend to be consolidated. There'll be some election angst, I'm sure. And there'll be some COVID angst on the vaccine or treatment front. It's never a straight line. Alicia, so, it feels like, we could pause. But ultimately, I'm still positive the direction of travel is upward.
Which ratio is your key valuation metric right now? Is it price to sales? Are we rationalizing like Amazon? Or is it price to cash flow? Is it something like across to the balance sheet, total enterprise value to EBITDA? Which is the ratio that matters to Alicia Levine?
So I think that's a great question. I've been talking to people, been in the market for 20, 30, 40, 50 years in the last few days. No one's actually seen anything like this. It's kind of extraordinary. I'd say right now it's really cash. Cash is king, and, the ability to plow back into the business. And, clearly, I'm just
understandability behind their rise. Tesla gaining 415%. Are there pockets of froth here?
Oh, for sure. There are certain names you can't explain, and I think that's one of them. There is a momentum going. Let's just for Tesla, just for 1 second, was the largest short in the market, and it was the largest short not only on the institutional side but also on the retail side. So part of that price action, it was that technical there. But clearly, we joked about this last time. Parabolas do not make great technical charts, and there'll be a day, but it can go on longer.
Okay, folks, what you got to understand here is Alicia Levine is prodigious in math, so we're going to do Math Thursday here in this long hour. What do I mean by a long hour? We start out at 8 a.m. Wall Street time, and we're really going to 9:10, which is a speech of Chairman Powell. We've got some special coverage on that we'll tell you about here in a moment. Alicia, come on, Alicia, you're going all squared on me here with the parabola, and that comes back to gamma or convexity, the bet that's on there. Is there a market overweight right now? Everybody's telling me there's money on the sidelines, but is there room there for gamma, for acceleration?
There's room for other sectors to move and not have tech destroyed, because you don't have to sell tech to buy the other sectors, right? Because there's cash. You've got $5 trillion of cash on the sidelines, and so much money has gone into the bond market, and it'll be let's bring in Jay Powell. This is the big story for the morning. What are we going to hear today? And they're going to sit on rates even as we see inflation moving upward.
Alicia, you've done a great job answering Tom's gratuitous way of getting gamma in there. Really, Tom? Seriously, she's not even focusing on the technical
Every
as
day,
much.
come on. Alicia read her Shelton Natenberg. I mentioned Shelton Natenberg, folks, yesterday. I got a huge response to that from geeks on Wall Street. Mr. Natenberg came out of Chicago years ago with a definitive one volume on the Greek letters. It's read like the Old Testament on Wall Street as well. Alicia, where's the Greek letters here right now? There's a whole bunch of Greek letters. Which of those matters to Alicia Levine?
So what matters to me right now is the positive rate of change, right? So the second derivative. That's what matters to me right now. And that's what matters to markets. And we forget that at our peril. It's never the absolute level. It is the rate of change. And every time investors forget that, they're on the wrong side of the trade. And the reason the market's moving upward is because the rate of change continues to be positive. Here in the U.S., the data has been getting better in the last few weeks. It is coinciding with COVID cases essentially rolling over on that bell curve, very similar to what we saw in April. Will they stay there? Hard to say. But the data have gotten better, and the positive surprises have been there. And that is why the market can continue to move higher. It's the rate of change. Newtonian mechanics with Alicia Levine. It doesn't get better than that. With BNY Mellon, they're back at BNY Mellon. The general counsel's going, what did she say? Alicia Levine with us this morning. Thank you.
What did he say? What was he asking her? With
Lisa,
which letter?
That's more math, Lisa, than you had in 4 years in Chicago. I'm kidding, of course. Excuse me, we got a lot coming up. I want to tell you about a special moment for us here. Gina Zanino is going to join us here from Ionia College on the festivities in the president's speech tonight, I should say. And then what we're really going to do is strap forward with Michael McKee into the jobless claims, and he will join us with Megan Green to prepare for this speech of Chairman Powell. Michael McKee and Megan Green with us here in a bit. Right now, we got lots coming up. Gene Zanino, give me some hurricane footage here, Riley, if you can. It is a calmer shore with substantial flooding, and yes, we're beginning to see the flooding near Lake Charles here this morning. Really, many tens of miles in, and of course, we're going to see a lot more as the storm moves through Shreveport and up across the Mississippi River and east as well. Let me do a data check right now. It is important in this busy, long hour. It is a 70-minute hour on radio, on television. Futures at -9, Dow futures -73. Yields off the higher yields yesterday reverse. Call it the churn of August as well. But I really want to focus on that real yield, -1.06, showing the nominal yield lower and inflation expectations still elevated as well. Dollar stronger today. Euro, I haven't even done the euro today. I've been remiss, as they say.
Or the lira.
I'm sorry, Lisa. 118.07. And Abramowitz demands the Turkish lira in from a 740 to a 734. That's a stronger Turkish lira over the last 2 days. Much more in this historic hour. Stay with us. A simulcast. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. Hurricane Laura is battering Louisiana with high winds today. It also brought it the threat of a catastrophic storm surge and flash flooding. The storm came ashore near Cameron, Louisiana, with maximum winds of 150 miles an hour. That made it one of the most powerful hurricanes ever to hit the state. Winds have now died down some. Still, Laura may cause $15 billion in insured losses. There are concerns that some areas could be inhabitable for months. Mike Pence accepted the Republican Party's nomination to be President Trump's running mate again. On the third night of the convention, Pence praised the president and blasted Joe Biden.
Where we fought for free and fair trade, and this president stood up to China and ended the era of economic surrender, Joe Biden has been a cheerleader for communist China. He wants to repeal all the tariffs that are leveling the playing field for American workers. And he actually criticized President Trump for suspending all travel to China at the outset of this pandemic.
Pence spoke from historic Fort McHenry in Baltimore. And the National Basketball Association started a boycott over police shootings. Now it has spread to baseball, soccer and women's basketball. That led to a number of games being cancelled. The NBA protest could lead to the playoffs being scrapped. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
To have the world's first safe, effective coronavirus vaccine by the end of this year. And we're not just opening up America again. We're opening up America's schools. After all the sacrifice in this year like no other, all the hardship, we're finding our way forward again.
The vice president last night, I will say that the punditry of the East Coast is tearing to shreds that piece. John Cassidy, publishing moments ago in the New Yorker, I would suggest not Trump-friendly, tearing to shreds the vice president's speech last night. And, of course, we saw that in the Washington Post with their fact-check effort last night as well. Right now, not so much to look back, but to look forward to the president's speech tonight. Gene Zeno joins us here, Bloomberg contributor and with Iona College as well. Gene, what will we listen for from the president tonight?
Well, I think, I am so curious to see how he handles these four major crises that are erupting right now. I mean, certainly he should have been prepared for the pandemic, the economic crisis, the racial unrest, but you add to that also the hurricane. And we have four major crises going on. I'm curious to see what his tone is, how he handles them, how he addresses them, particularly, obviously, the pandemic, because, of course, it's where he suffers the most in the polls. But also, let's not forget the hurricane, where in the four executive orders, some of that money came from the FEMA money. So, when those executive orders were issued in early August, many people said, well, what happens if we have another hurricane? So it's a lot for him to manage tonight.
But, Jeannie, what's so brutal here is the unemployment rate. We've had a number of frontline economists go out over 10%, and with a slow recovery as well. We've got claims here, folks. In 15 minutes, Michael McKee will join. Is anybody going to talk about the job economy?
Well, all we've heard the last three nights is that if it wasn't for the pandemic, the economy was humming along. He was doing a great job. This once-in-a-lifetime, once-in-a-century crisis occurred. Yep, and to your point, I think one of the things I found lacking, and I found lacking all these three nights, and certainly in Pence last night, there was a lot of praise for what they've done and not a lot of telling us how they move forward on issues like the unemployment number as it exists now, because, of course, the pandemic did occur and unemployment is what it is.
Jeannie, Tom was talking about John Cassidy writing in the New Yorker, talking about the Washington Post. How about outside of that? That is not President Trump's audience. That is not Vice President Mike Pence's audience.
Stop. That's a surveillance break exclusive. Lisa, are you telling me the New Yorker audience is not a Trump audience?
I'm just saying. I'm putting that out there because there is a dissonance here. Yes, I am suggesting that, Tom Keene.
Okay, very good.
But Jeannie, I'm just wondering, how are these speeches, how is the RNC being received by the people who it is geared toward?
And I love the fact that you raised that, because I think we get so much in a bubble we forget, and you're absolutely right. Mike Pence has long been President Trump's conduit to the white evangelical voters, and he remains that. And you watched him last night, and you listened to him, and he is still very much that. And all the talk and the chatter before that he might get bumped off the ticket and they might put in Nikki Haley or somebody else. President Trump cannot afford to do that because he needs those white evangelicals. He needs an interpreter like Mike Pence to go out there and make the case, and Mike Pence does do that. Now, whether he did enough to overcome the deficits the president is facing is another question. We don't know that yet. But to that extent, he is an important conduit. And last night, he made the case the president wants to make. The socialism theme, you talked about that a little bit, the law and order theme, he's been hitting on those hard, and he's been trying to make the presidency much more empathetic and let evangelicals know you're safe voting for him again. Look what he did to save abortion, to save the right to life. Look what he's done with the judiciary. Look what he's done with regulation, going right down the litany of issues they care about.
Jeannie, to Tom's point about unemployment rates, the idea that it is currently double digits at a time of growing distress, how is it that President Trump still has the upper hand with voters when it comes to who is better situated when it comes to economic issues?
You know, I think some of that is historic. I also think that people do look back before the pandemic, but I do think there's been a tendency in the modern era to say Republicans were safer with Republicans handling the economy. And of course, President Trump did have a very good economy and historically good unemployment numbers before the pandemic. But again, to your point, we're not hearing, at least maybe we'll hear tonight, we haven't heard so far. The reality is it is at this point right now, and what are you going to do to restore it? What we keep hearing is if you take a chance on Joe Biden, things are going to get a lot worse. We're going to be living in a dystopia, and unemployment is one of the many things that is going to be, you know, skyrocketing under a Joe Biden presidency.
Do you expect any surprise policy announcements tonight?
I hope we get policy announcements. We haven't gotten a lot of those, but I would hope the president would. I don't know if we're going to get surprise policy announcements. I do think he's a master sort of television production person, so I would suspect we get some surprises. You know, some of us in the back room last night were laughing. Maybe we'll see a Kanye West or something like that, but I don't know. I can't predict.
Jeannie, doesn't he drop a bombshell after calling Senator McConnell and saying, look, I'm going to get a stimulus done tonight on national TV, and he goes halfway to where Speaker Pelosi is? Isn't that like the win-win?
That would be an enormous win, and if we could get that I think would be really, really important. And it would be a surprise because, of course, we're hearing from the chief of staff that we're not going to see a deal in the offing until September at this point. So if that happened, I think that would be a win for all of us, but particularly the president politically. That's the kind of thing we would like to see. I'm not so sure Nancy Pelosi would meet him halfway at this point because politically it's not in her interest.
Jeannie, thank you so much. Jeannie Zeno with us here as we look at the Republican National Convention. Again, 9 p.m. tonight, David Weston with our coverage. Lisa, 5 minutes away from his claims statistic, Michael McKee with us as well. Futures improve a little bit. -9 becomes -6. We're looking at little micro moves here.
Yeah, and really interesting to see also the continuing claims. How much are the people on ongoing pay from the government? How much could it potentially come down or not? Currently, the expectation is for 14.4 million claims. Let that sit in. What carnage we have seen in the jobs market this year.
Yeah, we really lost perspective of it. And I must admit, some of these interviews we're having, the disparity between equity strategists optimistic, including what we heard from Alicia Levine and The Economist, they're just miles apart. I know Ron Insana had a nice tweet out moments ago talking about the separateness of the stock market from what we see within small business America as well. Lisa, what else do you see in the bond market right now besides this real yield, -1.05%?
Well, it raises this question, the negative real yields, about how low actual yields can go at a time of rising inflation expectations, right? Because we're expecting Fed Chair Jay Powell to come out at 9:10 and say, we're going to stay low until inflation starts picking up. We've been wrong. And what does that mean if yields are coming down and inflation expectations are going up? It means further negative real yields.
We'll see as well. Megan Green scheduled to be with us here to talk forward to the Powell speech. We're thrilled that she could join us in the Kennedy School. Right now, it is Galveston. This is west of where Laura hit Louisiana with 150-mile-an-hour winds. Of course, the storm has moved on the eye in the vicinity of Shreveport, moving at 15 miles an hour north. Category 4 now down to Category 3. Stay with us, a simulcast. This is Bloomberg.
It's such an interesting new world.
The world is changing. For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging. We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
The rapidity with which we are moving relates more to technological advances in how you can make a vaccine even before you start testing it. That makes me confident that we are going to do everything we can to determine safety.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Good morning, everyone. Bloomberg Surveillance is simulcast on Bloomberg Radio, Bloomberg Television. Lisa Abramowitz and Tom Keene. John Farrow is off this week, and we wish him well as well. Right now, it is widely acclaimed, arguably more important than the Powell speech. Michael McKee with us with the weekly claims statistics, which have been in the vicinity of 1 million. Michael?
Well, Tom, we're still in that vicinity. We come in at 1,006,000
jobless claims for last week. So we're still seeing the same kind of new jobless claims and the same kind of number of people becoming unemployed each week. No surprise, that was pretty much what the consensus was. But when you think about it, and you've had 21 weeks in a row of 1 million, you go down to 971 one week, and then now 2 more weeks over 1 million. You're looking at a labor market that is still in a lot of trouble. We're looking at the number of people who get pandemic claims, 607,806. That's an increase from last week. So the people who get claims benefits, or who are filing for claims benefits, who are freelancers and gig workers, rises as well. The total number of people who are getting any kind of benefits now, just over 27 million. So it shows you how far we have to go. The other thing we want to mention is the revision of GDP is out. It's a tiny bit better. The economy contracted 31.7% in the second quarter. That's down from 32.9%. No real change in personal consumption, 34.1. We'll have to look up what it is that we actually see different here. I'll look into this number a little bit more as well.
This is unfair, Michael, but you're so good at this, I'm going to throw it at you anyways. I've been dying to ask you this question since I spoke with a congressman from the 4th Congressional District of Arkansas. That's the Hot Springs Clinton District. Michael McKee, are claims in the part of America that's really not involved with the pandemic, are they sharply different than what we're seeing in other really aggrieved areas?
No, and that's interesting, although there is really no area that's not affected now. A lot of the places that we did see the pandemic skip in the beginning of this crisis back in the spring have now experienced it, and the numbers have gone way up in the South and now the Midwest. And we're looking at our states that have gone through this increasing the number of claims. And so it is something that hits everywhere. And, you know, if you're a politician, it's hitting the Midwestern key states that the two parties are going to battle over. So definitely something to keep in mind. The fact that this is still going on is certainly not good news.
Mike, we're talking to you after jobless claims in a little bit higher than expected, above 1 million for the 23rd of the past 24 weeks. Meanwhile, again, as you said, continuing claims coming in actually with an increase from the week before. I want to talk about the market response. You're seeing yields go a little bit lower, particularly the 10-year yield, but not markedly so. And in stocks, you're actually seeing the S&P futures retrace losses from earlier, almost flat on the day. How do you explain this, Mike? This doesn't seem like a better than expected report to me, and yet it's being treated by the market as being priced in, even with potential deterioration.
Well, you have to look at what the expectations were, and the expectations were for 1 million people filing for jobless claims. But I think, Lisa, what we're getting is a standard, if small, knee-jerk reaction to bad economic news. Bad news is good news because it means lower for longer for the Fed. Obviously, today the dynamics are a little different because you have Jay Powell speaking in about 30 minutes, and we will see whether he adds anything to the market's assessment of the economy and what the Fed is going to do. Yeah. But you'd have to expect that at this point, you know, the markets can't move a whole lot because rates are so low, but that they would see this as just a confirmation that things are bad and the Fed is going to be still keeping interest rates down.
But Mike, here's what I don't understand. What more can the Fed do to improve the jobs market at this point?
That's the issue, Lisa. Now, the question that comes up in terms of that, I mean, certainly they can't do a whole lot more stimulus, but they can keep rates low. But the question is, does Powell talk about average inflation targeting? That's been the Wall Street expectation, the idea that they tie inflation, and they tie their policy moves to a rate of inflation that runs above their 2% target for a while in order to let them bring unemployment down more, which is sort of what they have been doing, but it's not their formal policy. So Wall Street wants to know if he's going to sort of outline that, and then maybe at the September meeting we hear more about it. That's going to be the question for investors today.
Michael McKee is going to go off and have the Man of the Mountain breakfast at the Pioneer Grill right now, and he'll rejoin us here in a bit to drive forward to this important Fed speech. Right now, we're thrilled to bring you Megan Green. She's at Harvard Kennedy School School, a senior fellow, and has just done brilliant work folding market economics and acute analysis into the broader theory of what we're doing in economics, and of course how it links into finance and investment as well. Megan Green, thank you so much for joining us today. Megan, I really want to go to the arch issue, which has been the battle of our textbooks, rules and discretion in this new, more surgical idea of targeting. Is there any proof that a central bank can target anything?
Well, there's more and more proof that a central bank can't target much of anything. They can target the rate that they're setting, but the Fed's dual mandate is full employment and stable inflation of 2%. And on the latter, inflation, the Fed's missed the mark for the entire past recovery. In fact, since the Fed adopted a 2% inflation target in 2012, inflation has averaged just under 1.5%. So when Jay Powell does get up, and it's widely expected that he'll provide the broad brushstrokes of a change in the Fed's target towards average inflation so that there's a catch-up factor, meaning that the Fed will overshoot on inflation to offset undershooting for so long. I do think investors might ask, can the Fed overshoot on inflation? It's been so far under its target for so long. There's a real credibility issue. And the Fed has to promise that it will overshoot on inflation in the future, which requires upfront credibility when it hasn't really built any.
How do you mechanically, or what is the reaction process that gets you to overshoot inflation?
I mean, if the Fed really wanted to overshoot on inflation, it could provide helicopter money and achieve it, I think. But within kind of the political feasibility of what the Fed can do these days, I don't think there's a whole lot that the Fed can do to even hit its target, particularly now when we're facing a huge and persistent drop in demand. So I don't think the Fed can generate inflation of over 2% right now. There are concerns, though, that the supply side aspect of this crisis will come through and generate some inflation. So the Fed might get lucky for a little while and have inflation overshoot its 2% target, but I doubt that will be sustained.
Megan, we can't get good inflation unless we get more jobs back. And not all job losses are equal. Initially, people were saying that they were temporary job losses. Now they're increasingly permanent. They're increasingly high paid. And I am unclear on what the Fed can do to improve this picture. Are Fed actions at this point actually hurting more than they're helping because they take the pressure off Washington?
Yeah, so I think you're right. The Fed can't do much about the job market right now other than keep rates really low, try to run the economy hot to bring in workers, which, by the way, the Fed was already trying to do during the last recovery. I think it's really up to fiscal authorities to do something to try to address the labor market. So it's not up to the Fed, though. I do think that when Jay speaks later today, he will probably provide a slightly bearish view on the economy so that he can keep the pressure on Congress. And I suspect he'll mention that fiscal policy is the most important thing right now, as he has been doing.
But when we talk about inflation, Megan, we're getting plenty of inflation in asset prices. And I do wonder whether at a certain point it becomes harmful without some sort of fiscal backdrop, without some sort of help that actually can help the actual economy. Do you see the asset inflation as being pernicious at this point, or does it have more room to run before it reaches that?
I think it probably has more room to run. It depends on what markets you're talking about, right? We've seen incredible leverage taken on during this crisis, and that'll be a problem one day, but it won't be a problem as long as debt servicing costs are so incredibly low because rates are so low. The stock market looks frothy. I don't think anyone would doubt that, but I think that as long as the Fed is stuck in, even without an average inflation target, we all know that the Fed's not going to hike rates anytime soon. I think that has a bit further to run.
Megan, I want to play off Jared Kushner now over at the Death Star talking about the president's speech tonight. And, Megan, I want to talk about a hopeful America. Mr. Kushner says the president will speak of a, quote, hopeful, unquote, America. How does Jay Powell do that? How does he generate a hopeful message today when I've got a number of leading economists looking at double-digit unemployment coming down slowly?
Yeah, I think it will be hard to do and is probably not really in Jay's best interest, since, as I said, he'll want to keep the pressure on Congress to come up with a fiscal stimulus, which probably won't happen until September at best at this point. But I think you could look to some data points like retail sales, durable goods, which improved. The problem is that all the kind of high-frequency alternative data sources suggest that this recovery is already petering out, and I think it could could turn into a downturn if we don't end up re-upping some of the fiscal stimulus.
Megan Green, thank you so much. Greatly appreciate it. With the Kennedy School at Harvard. Lisa, 30-year bond breaking out under 140. I mean, it's little moves here, but nevertheless, some of the tension indicative of what we're going to see in 30 minutes.
Which is exactly how the Fed can respond to this, how much lower yields will actually help the labor market, and how does the market even respond to this economic data that looks pretty terrible, but is in line with terrible expectations, I suppose, Tom?
I go to what Mark Chandler said, which is the real shock here will be if this is a yawner. It's so widely anticipated that it'll speak about this new regime of inflation. We'll talk to Mike McKee about that at much greater length here in a moment. And of course, all the other papers at Jackson Hole, sometime they can really be controversial, Lisa, as well. But again, it comes back to this labor economy that we're seeing. The GDP redo for the second quarter was appalling. There's no other way to put it. At least I get that's ancient history, but nevertheless, the nominal yield, how far below 1% that 10-year benchmark is.
Yeah, I will say it is interesting that central bankers, their goal these days is to be yawners, is to say nothing, that shake the boat not at all. And the idea that you have Jared Kushner coming out and saying Fed's Powell has really stepped up to the plate is potentially even a problem. It's a liability. He just wants to remain out of the spotlight.
That's great, but a lot of people have said game over for the Fed. Their toolkit now is fairly limited as they look for stimulus from the legislature like everyone else does as well. You can debate about what the stimulus will be, but there it is. Futures at -7, Dow futures at -44. Jay Powell in 25 minutes. Michael McKee next. Michael Darda on radio in a bit. Stay with us worldwide on radio and television.
With the First Word News, I'm Rishka Gupta. It's one of the most powerful storms ever to hit Louisiana. Hurricane Laura made landfall early today with winds of up to 150 miles per hour. They've now slowed down somewhat. Still, the hurricane brings with it the threat of a 20-foot-high storm surge and flash flooding. Authorities are concerned that it could make some areas uninhabitable for weeks. Vice President Mike Pence says America's economy is on the way back. At last night's Republican convention, Pence praised President Trump for the way he's handled the economic crisis caused by the pandemic.
Because of the strong foundation that President Trump poured in our first 3 years, we've already gained back 9.3 million jobs in the last 3 months alone. And we're not just opening up America again. We're opening up America's schools.
Pence also encouraged voters to question whether Joe Biden is, quote, nothing more than a Trojan horse for the radical left. The CDC is defending new controversial guidelines on coronavirus testing. The guidance says that asymptomatic people may not need tests. Many public health experts say it's a wrong turn that could restrict the number of tests performed. The CDC says the change was not influenced by the White House, and it's meant to clarify the limits of testing. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
For the run-up is things are getting less bad, and they continue to get less bad. You still have basically 0% interest rates. You have credit spreads that have tightened dramatically. You have funding widely available, and you're still having pretty good reports from many, many companies. So I think that's really what's going on, and the belief is that ultimately something will get done.
Christopher Harvey of Wells Fargo there with some optimism this morning on the equity markets. We welcome all of you, our simulcast on Bloomberg Television, on Bloomberg Radio, Quiet Markets, in anticipation in 20 minutes of the speech of Chairman Powell. Usually the speech will come out and there'll be a release across the Bloomberg of a substantial amount of headlines, and we'll get to that at about 9:10 a.m. Futures -6, Dow futures -30, but again, as I said, a quiet to the date. 30-year bond in under 140, 1.3942 for those keeping score at home. Here is the magic of Jackson Hole. You land your airplane at this little cute airport. You drive north 10, 15, 20 miles, go down a road, and there's this beautiful lodge overlooking a mountain range. Michael McKee has been there so many times. He's climbed all of the Grand Tetons, right up to where the snow is. He's counted the moose, seen the bear, the whole thing, and all he knows is what matters is in a room next to the famed stuffed grizzly bear at the Jackson Hole Lodge. It's a virtual meeting this year. Michael McKee, what will go on in that virtual room?
In the virtual room, we'll have the same thing as we normally have up there. This is what people don't understand is this is an academic conference. Papers are presented about theories and problems in monetary policy making and are discussed. They're thick with math. They're discussed by nerds, for nerds. It is usually not a place where people go and make decisions. I mean, we had that a couple of years with Ben Bernanke.
To be clear, Michael, this is not going to be a nerd speech from Mr. Powell. He is speaking to an America with double-digit unemployment.
That does put a little more weight on his appearance today. The question is, does he see this as the venue to make any kind of announcements? And really, what kind of announcements can he make since the Fed's already at zero and done so much? There probably isn't a lot that would move the markets in the sense that they did back in March when they were moving monetary policy around. The real focus is, does he talk about what the Fed's policy framework is going to be going forward? That's the announced topic of his speech. Is it just a review, or does he have something to tell us about how the Fed's going to do monetary policy going forward?
The backdrop is not the Grand Tetons. It is not moose and bears that are hunting down Tom Keene. It is a dismal jobs market. We just got the latest read on it. A confusing report showing increasing dispersion among the haves and the have-nots, both in terms of income, in terms of location. What have we learned, if you dig under the hood, you've had a few minutes now, of the latest jobs report showing yet another print of more than 1 million unemployment claims in the past week?
Well, I think you have to look at, as you say, under the hood, the real numbers, the non-seasonally adjusted numbers, which mean they're just the raw data, did go down into the 800 range, and that is good news, I suppose. And so the idea that we're still getting 1 million is a little bit an artifact of the seasonal adjustments of patterns from previous years. But even 800,000, I mean, the highest we'd had in the past was in the 600s, and that was in the middle of the great financial crisis. So at this point, we're still at a very elevated level. Plus, we now give unemployment insurance to people who are freelancers, and you've got 600,000 of them getting it. So this isn't just 1 million, this is 1,600,000. And that's an awful lot of people to be filing for the first time. This all began back in March.
Yeah, I'm struck by the lack of a response in markets. It seems like it's a dismal backdrop, but it's one that's expected and priced into markets. Everything seems to be priced in with expectations high that you're going to get another round of fiscal support. If we don't, what is the picture like? I mean, basically, should markets be responding more to the figures that appear like they are stabilizing, but perhaps are transforming in nature?
You know, I was talking to some bond market strategists, and I think the way they put it is probably the way to look at it, and that is that we're not so much responding to the economic data because they know the flaws in that, the fact that most of the monthly data is dated by the time it comes out, and it's hard to get a clear reading from the alternative high-frequency data. What they really seem to be focusing on is vaccine news. Every time we get a good headline on that, the markets react. And that's probably not a bad way to look at it, because this isn't going to really be over until people feel confident they can go out and not risk their health. And that'll probably be dependent on either some sort of really good cure for the disease or a vaccine.
Michael McKee, this idea of pushing inflation higher, is everybody on board with Chairman Powell on this? I mean, I understand he may not mention it today, it may be a delay, but is there a consensus on this, or is it one of those food fights that Alan Greenspan would never put up with?
Well, I haven't taken a whip count, as they would say down in Washington,
Nice.
but it appears from reading the minutes and from talking to a lot of these people that pretty much everyone is on board with the idea. Yesterday, we talked to Esther George. She's one of the biggest inflation hawks, and she said she has no problem with the idea of inflation running a little higher during a period of catch-up for the Fed. So if she's on board, then probably everybody is. It really becomes kind of a question of how you frame it. How far above the 2% level do you let it go, and for how long before you start to worry that inflation is going to get out of control and you have to take some sort of action? But they've discovered over the past year that inflation will stay down even as the unemployment rate goes way below what they thought was the natural rate, the rate that would start pushing prices higher.
Is this a regime change, as James Bullard said? I mean, is that what we're really talking about, is a regime change of theory?
It's a regime change of theory. It's not a change in the Bullard sense, because Bullard is talking about economic conditions, and the regime has changed in the sense that economic conditions are now a lot more terrible, but since he was at zero under his regime, doesn't change his policy making. We will talk with him later today, by the way, and get his thoughts on this.
That's, of course, Michael, I was selling that forward. You see how I segued that right into, I segued that right into your Bullard conversation. Lisa. This is good. Michael McKee, thank you. In great anticipation of this speech here in 6 + 10 is 16 minutes as well. Lisa, this is exciting. It's not the August doldrums.
Yeah, I will just say as a PSA for anyone whose kids are listening, it's pronounced Segway, not Segui, because there's some people who hear your pronunciation and take it at face value. Really aren't sure. I don't know. Well, to segue, there is some... To segue into some recent news, just want to give you this. Politico is reporting that Mark Meadows and Speaker Pelosi are scheduled to speak today at 2:30 p.m., presumably, about efforts for fiscal support. Interesting to see. You're scoffing.
Yeah, I'm scheduled to speak with John Farrow at some time.
Oh, you
today,
are?
But, I don't know. It's like,
The hills are alive in the fields of Tuscany.
Tuscany's a long ways away. That's all I know. Anyways, we've got a lot going on here. You need to stay with us on Bloomberg Radio, on Bloomberg Television, the Powell speech, and much, much more through the morning. And, of course, the President of the United States speaking tonight at his convention. James Bullard in the 1 p.m. hour. I believe Michael McKee's in the building and will be doing that interview. Futures right now improving a little bit, -5. Dow futures at -27. The VIX 23.32. Stay with us. In 15 minutes, Jerome Powell. This is Bloomberg, a simulcast.
suppose you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
Does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City for our viewers worldwide, I'm Taylor Riggs, and for Jonathan Farrow, the countdown to the open starts right now. And we begin with the big issue, the equity rally stalling ahead of Fed Chairman Jay Powell's speech. Investors gauging escalating geopolitical tensions and the economic impact of Hurricane Laura as it roars ashore in Louisiana. This all as U.S. jobless claims top 1 million for yet another week. Equity bulls hoping Fed Chairman echoes the dovish inflation comments from his colleague, Esther George.
I've never thought of 2% as a ceiling, but to really stay focused on what anchors inflation expectations in the economy. So from a communication standpoint, I think we will be talking about the kinds of things that help us do a better job of achieving our objectives.
Joining me now is Michael McKee, our Bloomberg International Economics and Policy correspondent. Mike, give us the key takeaways of what you heard from Esther yesterday and fold that into what we can expect from Jay Powell.
Well, of course, with not a lot else going on in the world, the markets are extremely focused on what Jay Powell is going to say in about 10 minutes on the virtual Jackson Hole, not out in the Tetons today. And much of what their focus has been on is average inflation targeting. The Fed did this year-long framework policy review, and the idea that Powell is supposed to outline what they found, that's the idea for today. And in doing so, he'll talk about the idea that the Fed can let inflation run above the 2% target for a little while to make up for periods in which it runs below 2%. Esther George, a key voice on this in the sense that she's one of the real inflation hawks on the FOMC, and if she's on board with it, then probably everybody is on board with it. The idea is that you'll pull inflation up because the markets and consumers will expect a little bit higher inflation. The question is, how do you set this up so it doesn't go too far for too long? How long do you let inflation run above the target? And then, of course, the question underlying all of this is, can the Fed even pull it off? They had rates at 0% for 7 years after the financial crisis and couldn't get inflation sustainably above 2%. So does this strategy, A, work, and B, what is it exactly going to do for inflation and for the economy?
Well, Michael McKee is going to be staying with us through this whole hour. In the meantime, I do want to see how markets are setting up ahead of Chairman Powell's speech. Let's go on over. Bloomberg's Abigail Doolittle.
Well, Taylor, we don't have too much movement for the major financial markets at this point. If we take a look at what's happening for U.S. equity futures, bonds, and the dollar, along with some of the commodities, very flat with the exception of gold, really telling you that, as Mike McKee was just saying, investors really waiting to see what will Fed Chair Jay Powell in fact see. The S&P 500 E-mini futures at this point down just slightly. We have the Bloomberg Dollar Index down at this point ever so slightly. Bonds rallying a little bit. The 10-year yield is down by about 1 basis point. Now, interesting, gold is making the biggest move out of the markets we're looking at this point, down about 0.7%. That may suggest that some folks, and those are gold futures, so spot gold, I should say, is down closer to 0.7%, suggesting that maybe some folks are thinking that Fed Chair Jay Powell will somehow be slightly hawkish. When you look at gold, that message can sometimes come out. And then one of the big winners on the day relative to commodities, soybeans up 1.2%. So that part of the risk asset complex is rallying right now. But again, overall, Taylor, into today's speech by Fed Chair Jay Powell at Jackson Hole, the virtual version, not a lot of movement for markets. Investors really waiting to see what will he say.
Bloomberg's Abigail Doolittle, thank you. Nisha Patel, Parametric, expecting Chairman Powell to be a bit vague, writing the speech will be, quote, less on specifics of what the new framework may be. It is likely that he may mention that yield curve control is not necessary. The focus may be on a shift to targeting an average inflation target, allowing room to overshoot that target. And Nisha Patel joins us now. Nisha, this has really been the question all week leading up to this. I think the other big question, though, is how do you even get to an averaging when we just heard from Mike McKee, we can't even get to 2%?
Exactly. I mean, post-2008, in a very accommodative monetary policy environment, it was very tough to reach a 2% and even maintain that. And I think even at that point in time, it might have been a matter of time if the crisis and pandemic had not occurred to the Fed shifting towards an average inflation policy at that point. So I certainly think that the average inflation policy is certainly going to be highlighted. However, I do, anticipate some of the framework around it to be a bit vague because, again, how do you measure the inflation? Do you use new metrics? Do you also include calculations of nominal GDP targets? And I think a lot of these things, unfortunately, the Fed and Chairman Powell may not have the answers to, but over the next few weeks until the September meeting, they may be able to iron this out. I do think a bulk of this speech will be more around the tone around what the economic conditions is and how the Fed perceives kind of the outlook to be and how they've viewed this so far recovery, if you will, and improving economic data.
Nisha, talk to me, educate me on what comes first, the chicken or the egg. We have charts that show inflation starts to rise and the Fed starts to raise rates. Or do we think it's the other way around, that they start to see some pressure, they raise rates, and then that, of course, is the feedback loop that starts to raise inflation? How are you thinking about how the two are related?
Yeah, historically, I think the Fed might have preemptively raised rates as they saw some signs. But we're in a completely different environment now. You could argue there are a lot of inflationary, deflationary forces. Technology is a very big change that has occurred over the past few decades that is really going to shift how the Fed is going to now view inflation and, again, what they're going to look for before taking any action. You could argue that the Fed tightened too quickly, right, a few years back.
Yeah,
and
Nisha,
so
we're going to have
shift in there being inflation, letting it, let's say, overshoot that target for whatever time frame they may pick, and then taking some action and being okay with the fact that they may be a little bit late, if you will.
Nisha, we're going to have to thank you and leave it there, Nisha Patel. In the meantime, I want to go on over to Bloomberg's Mike McKee. Mike?
Well, Taylor, Jay Powell has started speaking at the virtual Jackson Hole, and there is news in the speech today. The Fed is announcing today that it is changing its monetary policy framework. The Fed is going to, at this point, now base their policy on shortfalls in employment rather than deviations, which is what their current policy is. They are going to take into account the idea that they can bring unemployment down further than it has in the past before they react, which means they will seek inflation that averages 2% over time. If you have had a period in which inflation runs under 2% for a time period after that, you will let inflation run above that. The Fed not specifying either an unemployment target or a period, how long the period would be or how far they would let inflation go. But in this case, they are going to let inflation run above 2% for a while. They're also adding financial stability to the policy decision-making process. In other words, what's happening in the financial markets. And they are going to conduct a review like this every 5 years. So Jay Powell making news today with a new Fed policy framework should mean lower for longer. We'll see what the markets do with it. Here's Jay.
Before the Great Moderation, expansions typically ended in overheating and rising inflation. Since then, prior to the current pandemic-induced downturn, a series of historically long expansions had been more likely to end with episodes of financial instability, prompting essential efforts to substantially increase the strength and resilience of the financial system. By the early 2000s, many central banks around the world had adopted a monetary policy framework known as inflation targeting. Although the precise features of inflation targeting differed from country to country, the core framework always articulated an inflation goal, the primary objective of monetary policy. Inflation targeting was also associated with increased communication and transparency, designed to clarify the central bank's policy intentions. This emphasis on transparency reflected what was then a new appreciation that policy is most effective when it is clearly understood by the public. Inflation targeting central banks generally do not focus solely on inflation. Those with flexible inflation targets take into account economic stabilization in addition to their inflation objective. Under Ben Bernanke's leadership, the Federal Reserve adopted many of the features associated with flexible inflation targeting. We made great advances in transparency and communications with the initiation of quarterly press conferences and a summary of economic projections, which comprises the individual economic forecasts of FOMC participants. During that time, then Board Vice Chair Janet Yellen led an effort on behalf of the FOMC to codify the committee's approach to monetary policy. In January 2012, the committee issued its first statement on longer-run goals and monetary policy strategy, which we often refer to as the consensus statement. A central part of this statement was the articulation of a longer-run inflation goal of 2%. Because the structure of the labor market is strongly influenced by non-monetary factors that can change over time, the committee did not set a numerical objective for maximum employment. However, the statement affirmed the committee's commitment to fulfilling both its congressionally mandated goals. The 2012 statement was a significant milestone, reflecting lessons learned from fighting high inflation, as well as from experience around the world with flexible inflation targeting. The statement largely articulated the framework the committee had been following for some time. The completion of the original consensus statement in January 2012 occurred early on in the recovery from the global financial crisis, when notions of what the new normal might bring were quite uncertain. Since then, our understanding of the economy has evolved in ways that are central to monetary policy. Of course, the conduct of monetary policy has also evolved. A key purpose of our review has been to take stock of the lessons learned over this period and identify any further changes in our monetary policy framework that could enhance our ability to achieve our maximum employment and price stability goals in the years ahead. Our evolving understanding of 4 key economic developments motivated our review. First, assessments of the potential or longer-run growth rate of the economy have declined. For example, since January 2012, the median estimate of potential growth from FOMC participants has fallen from 2.5% to 1.8%. Some slowing growth relative to earlier decades was to be expected, reflecting slowing population growth and the aging of the population. More troubling has been the decline in productivity growth, which is the primary driver of improving living standards over time. Second, the general level of interest rate.
we are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with a 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue, the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Continued, the gains began to be shared more widely across society. The Black and Hispanic unemployment rates reached record lows, and the differentials between these rates and the white unemployment rate narrowed to their lowest levels on record. As we heard repeatedly in our Fed Listens events, the robust job market was delivering life-changing gains for many individuals, families, and communities, particularly at the lower end of the income spectrum. In addition, many who had been left behind for too long were finding jobs, benefiting their families and communities, and increasing the productive capacity of our economy. Before the pandemic, there was every reason to expect that these gains would continue. It is hard to overstate the benefits of a strong labor market, a key national goal that will require a range of policies, in addition to supportive monetary policy. Fourth, the historically strong labor market did not trigger a significant rise in inflation. Over the years, forecasts from FOMC participants and private sector analysts routinely showed a return to 2% inflation, but these forecasts were never realized on a sustained basis. Inflation forecasts are typically predicated on a natural rate of unemployment, or U star, and of how much upward pressure on inflation arises when the unemployment rate falls relative to U star. As the unemployment rate moved lower and inflation remained muted, estimates of U star were revised down. For example, the median estimate from FOMC participants declined from 5.5% in 2012 to 4.1% at present. The muted responsiveness of inflation to labor market tightness, which we refer to as the flattening of the Phillips curve, also contributed to low inflation outcomes. In addition, longer-term inflation expectations, which we have long seen as an important driver of actual inflation, and global disinflationary pressures may have been holding down inflation more than was generally anticipated. Other economies have also struggled to achieve their inflation goals in recent decades. The persistent undershoot of inflation from our 2% longer-run objective is cause for concern. Many find it counterintuitive that the Fed would want to push inflation up. After all, low and stable inflation is essential for a well-functioning economy. And we are certainly mindful that higher prices for essential items, such as food, gasoline, and shelter, add to the burdens faced by many families, especially those struggling with lost jobs and incomes. However, inflation that is persistently too low can pose serious risk of the economy. Inflation that runs below its desired level can lead to an unwelcome fall in longer-term inflation expectations, which in turn can pull actual inflation even lower, resulting in an adverse cycle of ever lower inflation and inflation expectations. This dynamic is a problem because expected inflation feeds directly into the general level of interest rates. Well-anchored inflation expectations are critical for giving the Fed the latitude to support employment when necessary without destabilizing inflation. But if inflation expectations fall below our 2% objective, interest rates would decline in tandem. In turn, we would have less scope to cut interest rates to boost employment during an economic downturn, further diminishing our capacity to stabilize the economy through cutting interest rates. We have seen this adverse dynamic play out in other major economies around the world and have learned that once it sets in, it can be very difficult to overcome. We want to do what we can to prevent such a dynamic from happening here. We began our review with these changes to the economy in mind. The review had 3 pillars: a series of Fed Listens events held around the country, a flagship research conference, and a series of committee discussions supported by rigorous staff analysis. As is appropriate in our democratic society, we have sought extensive engagement with the public throughout the review. The Fed Listens events built on a long-standing practice around the Federal Reserve System of engaging with community groups. The 15 events involved a wide range of participants: workforce development groups, union members, small business owners, residents of low and moderate income communities, retirees, and others, to hear about how our policies affect people's daily lives and livelihoods. The stories we heard at Fed Listens became a potent vehicle for us to connect with the people and communities that our policies are intended to benefit. One of the clear messages we heard was that the strong labor market that prevailed before the pandemic was generating employment opportunities for many Americans who in the past had not found jobs readily available. A clear takeaway from these events was the importance of achieving and sustaining a strong job market, particularly for people from low and moderate income communities. The research conference brought together some of the world's leading academic experts to address topics central to our review, and the presentations and robust discussion we engaged in were an important input to our review process. Finally, the committee explored the range of issues that were brought to light during the course of review in 5 consecutive meetings beginning in July 2019. Analytical staff work put together by teams across the Federal Reserve System provided essential background for each of the committee's discussions. Our plans to conclude the review earlier this year were, like so many things, delayed by the arrival of the pandemic. When we resumed our discussions last month, we turned our attention to distilling the most important lessons of the review in a revised statement on run goals and monetary policy strategy. The federated structure of the Federal Reserve, reflected in the FOMC,
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
maximum employment is a broad-based and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for many in low and moderate income communities. In addition, our revised statement says that our policy decision will be informed by our assessments of the shortfalls of employment from its maximum level, rather than by deviations from its maximum level, as in our previous statement. This change may appear subtle, but it reflects our view that a robust job market can be sustained without causing an outbreak of inflation. Rose toward its estimated maximum level in order to stave off an unwelcome rise in inflation. The change to shortfalls clarifies that going forward, employment can run at or above time estimates of its maximum level without causing concern, unless accompanied by signs of unwanted increases in inflation or the emergence of other risks that could impede the attainment of our goals. Of course, when employment is below its maximum level, as is so clearly the case now, we will actively seek to minimize that shortfall by using our tools to support economic growth and job creation. We have also made important changes with regard to the price stability side of our mandate. Our longer run goal continues to be an inflation rate of 2%. Our statement emphasizes that our actions to achieve both sides of our dual mandate will be most effective if longer-term inflation expectations remain well anchored at 2%. However, if inflation runs below 2% following economic downturns, but never moves above 2% even when the economy is strong, then, over time, inflation will average less than 2%. Households and businesses will come to expect this result, meaning that inflation expectations would tend to move below our inflation goal and pull realized inflation down. To prevent this outcome and the adverse dynamics that could ensue, our new statement indicates that we will seek to achieve inflation that averages 2% over time. Therefore, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. In seeking to achieve inflation that averages 2% over time, we are not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as
you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
On keeping inflation below 2%, but now they've realized that it's not going anywhere, it's staying below 2%, and because they could keep inflation at that level, or because inflation stayed at that level, unemployment came down much farther than anybody on the Fed thought was possible. So in the new framework, they are putting the emphasis on inflation, saying that the policy is going to be based on shortfalls in inflation, on what they think shortfalls in unemployment, what they think the unemployment rate can be, rather than necessarily what it is. They will allow, therefore, inflation to rise above their 2% target for what they say is some time. They probably are trying to keep flexibility in this rather than set an automatic period. But if it's run below 2% for a period of time, they'll let it run above 2% for a period of time in order to let unemployment keep coming down. The other thing they didn't specify, how far above the 2% target they would let it go. Most Fed officials have suggested 2.3 to 2.5 as long as it doesn't go above that. But in the past, what we've seen, Taylor, is when inflation starts to rise and it gets to 2%, the Fed starts to look at raising rates, and they're not going to do that this time. They also added financial stability to their decision-making process. They'll keep an eye on what is happening in the markets, whether or not there's a bubble.
Yeah, and Mike, we're going to have to cut you off. I'm sorry, and go back to Jay Powell as he continues speaking. Let's listen in
making monetary policy, but will aspire to have inflation run above 2% after periods in which it runs for an extended period below 2%, so that we can average 2%. So I think that that concept should be well understood. And I think it's the appropriate one. When we began the review, we understood that the situation we're in calls for an exploration of makeup strategies of various kinds, and this seems to us to be the right makeup strategy, where undershoots of inflation are not forgotten, but are made up in a way that allows us to to continue to consider all the other things that come into monetary policy, often unexpectedly, rather than trying to follow a particular formula.
Thank you. And so one way to think about that perhaps is the way that your colleague, Governor Clarida, has described it. It's more of an evolution perhaps than a revolution. So if I could just
I think that's very fair. Go ahead.
If I could just push that a little bit further, and we'll come back to the comments that you made about the framework, but with so much focus on the really challenging economic situation, the crisis that we're in at the moment, are there changes in monetary policy that people should expect to see as a result of some of these changes in the strategy that you have walked us through?
So I guess I would just set the stage a little bit. We began the review we announced it publicly that we were beginning a review in early 2019. So and we had planned to announce our conclusions, and indeed we're ready to announce our conclusions in the April or June meeting this year. So most of the work that was done, and there was a lot of work done, took place during 2019. So the review is meant to establish a framework for monetary policy that will guide our decisions for the foreseeable future. It was meant to take into account the learning that we did in watching a full business cycle take place after the global financial crisis. We had seen a full business cycle or close to it, and now we have indeed seen a business cycle. So I think we thought it was time to update. So it wasn't designed to dictate any particular future decision about interest rates or other monetary policies. However, all of the things we do going forward will be will reflect the changes that we've made to the framework. So I would think of it that way. It doesn't dictate particular outcomes, though, at particular meetings or the timing of those outcomes, other than the goals that we're seeking to achieve.
You mentioned a bit, and I'd like to hear a bit more about this. The rationale and your thinking for launching this review to begin with. You've mentioned that it was launched, of course, 18 months ago, so well before the current context. And I wonder if you'd say more about both what your motivation was for launching this, but also whether, as you look back on what the process was and how it unfolded, if you would have done anything differently.
Sure. So the review is really part of a broader program of enhanced transparency and accountability, really something the Fed's been working on for 30 plus years now. You know, today surveys show that public faith in large institutions around the world is under pressure. And so I think institutions like the Fed have to aggressively seek transparency and accountability to preserve our democratic legitimacy. And there are a bunch of things that we're doing. The review was the center of that, though. I thought other central banks have done various forms of reviews, not all of them of their broad monetary policy, but some had, and I thought this would be something we could do to get great benefits and also be able to update our framework. And the economic question we had to answer was how to adapt our framework to what we really had learned since the global financial crisis during that long expansion. As I mentioned, we knew that we were going to be closer to the effective lower bound in all likelihood, and had to address that as I described in my remarks. We didn't know how it would come out. I'm very happy with where it came out. I will, if you'll forgive me or allow me, just say for a second that we were in the design process of this when Vice Chair Rich Clarida arrived in the fall of 2018, and there were only 3 governors, I think, at the time. He had the time and really took this on and led it. And we would not be sitting here today talking about this without his great leadership efforts in bringing this thing forward. I'd also mention the other members of the subcommittee on communications, which Rich Clare's, Governor Brainerd, Eric Rosengren, and pretty much every member of the FOMC, every participant can look at the document and see their own views and input reflected. So I think in terms of, I mentioned some of the things, I think there were great gains just in the process of engaging with lawmakers and engaging with the general public on these issues and seeking input and accountability. I think that is a most welcome thing when you do that. And so I think even apart from the gains in the framework, that was something I was quite struck by. The Fed Listens events were just really striking. If you were in Chicago, I think that conference, there were 2 panels of people from low and moderate income communities who spoke about the economy in their lives, and it was just riveting. It was really, that was the highlight of that conference, which of course was chocked with global monetary policy experts. But to hear them talking about what a tight labor market means in their communities was something that none of us will forget. And I think we knew that intellectually, but I think hearing it a lot over the course of Fed Listens, and then seeing the sharing of the benefits of a labor market that's tight, in the sort of 8th and 9th years of the expansion, wages began to move up more for people at the lower end. We saw labor force participation. We saw employers doing lots and lots of things to recruit people who might not have been recruited earlier. So it's a very virtuous thing, and one that I mentioned in my remarks will take support from Congress over time too. It's not just about monetary policy. It's about education. It's about training. It's about healthcare. It's about all the things that enable people to get into the labor force and stay there and progress in their careers through the labor force. So I think those are some of the things I take away from the process.
So, I mean, as someone who did participate in at least some pieces of the process, I will also comment on just how public and open, as you mentioned, is not thought of as an institution that really does reach out to the public and engage in different ways. I wonder if you'd say a bit more about how, as a regular process, the influence of voices from the public actually does play a role in terms of monetary policy decisions and thinking, because that's a topic I think is not at all well understood by the public.
Well, we have, through the Reserve Bank system, we have a unique, really, presence in communities around the United States. And we're present in not just in the business community, but in educational, medical, through our community affairs groups, we're present in neighborhoods, and we harvest that information, and it goes into a lot of what FOMC participants say. It goes into the research that we do, it goes into the data that we collect. We collect a lot of unique data on diverse outcomes among different groups and that kind of thing. And all of that goes into our FOMC deliberations. In particular, it informs our understanding of what maximum employment really means. So we focus on, at every FOMC meeting, in every briefing, in pretty much all of my public remarks and my colleagues' public remarks in the monetary policy report, we will call out different, for example, unemployment rates and labor force results for different racial groups. Not just because it's the right thing to do, it really does inform our thinking about maximum employment. And so this is something that we're very focused on. These disparities are a longstanding feature of the American economy, and they really do hold us back, as Raphael Bostic so pointed out so well recently. They weigh on the whole economy, and so all of that goes into our thinking, not in a mechanical way, but in our understanding of what maximum employment is. And that's why you saw when during 2019, when the unemployment rate fell to 3.5%, well below most estimates of the sustainable rate, the natural rate of unemployment. You didn't see us raising rates or expressing concern. You heard us celebrating that, and you actually saw us cutting rates during 2019. Not because of that, but nonetheless, we weren't hesitant to cut rates because of the very low level of unemployment.
So just to follow up on that a bit, you have made some very strong and very clear statements about racial justice and the challenges of economic disparities, particularly related to racial inequalities. And of course, we know that many of those disparities are in such clear relief in the current context. And so I'd like to ask you to say a bit more, having explained to us that the employment mandate will be interpreted in a broader and more inclusive way. What else can the Fed do to address some of those really important disparities?
So I would say, as I mentioned, these are long-running features of our economy, which figure into our understanding of the economy and into our decisions. And I would say also that while they're long-standing, the pandemic has really shown that the effects of the pandemic have fallen to a large extent, not exclusively, but to a large extent, on people working in the service economy, in public-facing jobs, and these relatively low-wage workers, and that's been heavily skewed toward minorities, women, low and moderate income community. So, what can the Fed do? So as I mentioned, we do already. If you look at the record, we're doing lots of research around these issues. We're talking about it publicly, and we are talking about these issues publicly, and we're incorporating into our thinking. I think the key thing, though, is that the single most important thing we can do here is to support a strong labor market. And as I mentioned earlier, that is something that, we can do, but that is more of an all-government, all-society project that we can take on forcefully. It can't just be the way the Fed manages interest rates through the business cycle, although, in other words, it's not to wait until the 8th and 9th year of the cycle to get those kinds of results is, we can do better than that, but with other policies. I think we're doing those things that we can do, I think a lot of them we're doing, and we'll keep looking for new ways. It is important to point out, though, our interest rate policies and our other policies affect all Americans and are for the benefit of all Americans. They're just, in that sense, blunt tools, and there are better tools for dealing directly with distributional issues, and those are the tools that are held in our system of government by elected officials and the people who are appointed in the executive branch, who work for an elected official. So it is, as I said, it needs to be an all of government, all of society kind of thing. We'll keep doing what we can do, but I wouldn't, we really need it to be broader than just the Fed, and I think we're sort of doing the things that we think we can do now, and we'll keep doing them.
So it certainly does it have to be a broader effort. In that context, I wanted to just ask you a bit about some of the special programs, the facilities to try to get funds out into the community, in particular in places and for groups that are really struggling. As you know, the Fed has come under some criticism that some of those facilities are not reaching some of the groups that are the hardest hit. For example, minority businesses are often described. And I wonder if you'd say a bit more about whether there are additional things that the Fed could be doing, perhaps in partnership with others in that context.
So we did a lot of, on the Main Street facility, we did a great deal of outreach to community development financial institutions and minority depository institutions and other organizations that represent those constituencies. And so we're doing everything we can to reach those constituencies. Remember, this is a very broad program designed to make loans. So these are loans that we can make. We can't make grants the way effectively the PPP program does. That's really fiscal policy. What we're doing is we're making loans, and the law requires us to have a reasonable expectation that the loans will be repaid. A bank has to keep a 5% piece of that loan. So we are working to reach, smaller and medium-sized businesses through that. But I do think, this is a unique exercise for us. We've never done anything like that, lending to businesses. I would say we've never done it, but we've never tried to reach out broadly like this, particularly to smaller institutions. We're really not the ideal, and we're doing it. We've put more effort and work into the Main Street facility than everything else we've done. It's a very, very challenging exercise. We're making progress there. I think we're getting more and more banks signed up, more and more loans getting made. CDFIs and smaller community banks are in fact active. But it's going to take more than that. It's going to take, more direct aid, I think, to smaller businesses. And I think that's an area where fiscal policy can really do things that it's very hard for us to do. And in fact, the P program has been doing. So I would look to policy for help there.
Yeah, and so clearly it has to be a partnership to have the kind of broad impact that we would hope to see. I do want to talk a bit about the current crisis compared to other crises that the Fed has grappled with, and in particular, one of the questions that I get asked is to what extent, from the perspective of monetary policy, is grappling with a major recession that's caused by a pandemic any different from grappling with one that is caused by a financial crisis, as we saw back in 2008, 2009. Be very interested in your thoughts about that difference.
Yeah, so it's a very, very different situation. The two episodes, and I think so far the two beginnings of recovery and that recovery are quite different. This crisis did not originate in the financial system or from an asset bubble or from an imbalance or anything like that. And all of those were features of the housing bubble, housing crisis, and the financial crisis. That was the heart of the global financial crisis, and it was global in that sense. This really was a natural disaster that hit an economy that was doing well, with a banking system that was well capitalized and highly liquid and understood its risks pretty well, and it's actually been a source of strength. So that's very different. Although we have seen lines emerge in the broader financial system, in the capital markets, for example, under great stress. We've seen some, and no doubt we'll come back and look at those when it's time to do that. I mean, what happened here was essentially people around the world, sometimes required by their government, sometimes on their own, withdrew from certain kinds of economic activity to protect themselves from the pandemic all around the world. There's no precedent for that. There's no playbook for that. So our response was actually quite different from what it was in the financial crisis. So we immediately cut rates to zero. We raised our asset purchases essentially without limit to support market function. We weren't trying to stimulate the economy in the sense that the economy was partially shut down. The idea was not to stimulate people to go out to spend. It was to provide a little bit of comfort, to assure that credit was flowing to households and businesses, and then when the expansion came, to support that recovery and expansion with monetary policy. So very, very different. Also, this business of lending to non-financial corporates and also to state and local governments, unique. And that was because the intermediation process simply stopped. The financial system, there was such a flight to safety when the pandemic really hit that credit intermediation between savers and borrowers just essentially stopped. And we had to step in as a backstop for the municipal market, for the corporate markets, and have been doing so for smaller businesses. And we did so around the world for dollar funding markets. Now, that was similar to during the financial crisis. So it's very different. But I would say this, though. So we had the deepest quarter loss in GDP that we've ever had. But remember, the economy was strong back in February. So there's a lot of strength in the economy. The recovery in May and June came sooner and was stronger than expected. So there's still a healthy economy under here, except for this area that's been directly affected by COVID. So if we can keep the disease under control, the rest of the economy can recover fairly quickly. The problem this time is that there's a particular part of the economy which involves getting people together and feeding them, flying them around the country, having them sleep in hotels, entertaining them. That part of the economy will find it very difficult to recover. That's a lot of workers. That's millions of people whose jobs they're really going to struggle to find work. And we need to stay with those people. We need to support them and help them get back into their working lives, stay in their homes. Congress has done a lot on that. We've done a lot, and we'll keep doing what we can. But I do think it's that's going to be the issue. I think we will get through this period, maybe with some starts and stops, with reasonable growth. But ultimately, we're looking at a long tail of probably a couple of years at least of people of relatively high employment, as people who worked in those industries will struggle to find work. And again, we need to support them.
Yeah, so kind of very different trajectory as you've described.
Very.
So in that context, do you see any role for the Fed in terms of those financial institutions that really do community development?
We're very highly engaged with the CDFIs, the Community Development Financial Institutions, and those of them that are banks, are taking part in our programs now. They took part in the PPP liquidity facility, so we strongly support them, engage with them, and the same is true of MDIs. I think that isn't where the liquidity shortage is. That isn't where the big problems in the economy are really in the service sector and the manufacturing sector. It's in the real economy this time. The last crisis was really around the financial system and big credit losses. Here we've got highly capitalized institutions, and we have credit problems in the real economy, and we have we have a different situation this time.
Thank you. So we are almost out of time, unfortunately, and I thought what I would do for just our last minute or two was to cycle back to the review, this very public review of the monetary policy framework, and ask if you had any additional thoughts or perhaps the next steps that you expect the Fed to take in terms of moving forward with the changes that you've described for us.
Well, first of all, I'm very pleased with how this worked out. Again, I think it's productive from the standpoint of just public engagement, and that's always a good thing for an institution like the Fed, particularly the Fed, which has this precious degree of independence, and I think that puts a burden on us to seek accountability, not just go through the motions, but really actively engage and explain ourselves as clearly as possible to the public and the public's elected representatives. So I think the review has helped on that. I think in that sense, it's been a success. I think really the changes to our framework, time is going to tell. And what we do going forward is really going to decide the effectiveness of the changes we've made. I think it's a very promising set of changes to deal with what is a reality of a quite difficult macroeconomic context of low interest rates, low inflation, relatively low productivity, slow growth, and those kinds of things, and a flat Phillips curve. You have to put all that together and see that we've really got to work to find every scrap of leverage in helping stabilize the economy, which is our role. So time will tell, and our actions ultimately tell. But I'm very pleased with you and so grateful to be part of such a great organization where we've really used every part of the
out. So the Fed has, at least at this point, got itself a new policy that will, as Powell said, we'll see how it works.
Mike McKee, thank you as always there for your instant analysis. I want to look at some of that market reaction with Jared Woodard, Bank of America Research Investment Committee head, who is joining us now. Jared, your initial thoughts here, the round trip that we've seen in higher yields and those higher break-evens.
Hey, Taylor, glad to be with you. I think there's two really big important themes that I take from Powell's comments this morning. Number one, this is good for wages. If you think about the last 4 business cycles, the last 4 Fed hiking cycles, we always see the Fed traditionally begin a hiking cycle when wage growth starts to shoot above 2.5% or so. One takeaway, I think, from the message this morning is that the Fed's probably going to be a little bit more tolerant of increases in wages and wage inflation in the future. I think that's a good thing for markets. It's a good thing, especially for cyclical sectors of the economy that depend on workers with enough income to spend, people who've been, as Powell said, traditionally left out of a lot of economic expansions. If you see those parts of the labor force, those parts of the economy allowed to enjoy bigger wage gains, especially towards the end of a business cycle, then I think you can see much more upside opportunity for really cyclical sectors like financials and industrials, and that's actually precisely the sectors you can see rallying this morning. The other big point I think that is worth mentioning is what this means for bonds, especially from a market's point of view. Do bonds perform the kind of hedging function, especially treasury bonds, that they've done in the past? One thing we didn't hear this morning was anything about yield curve control. And so there's a lot of concern about that among investors. I think the big takeaway is if the Fed's not going to commit to a yield curve control policy, but is going to push growth higher, let inflation run hotter, look to reduce unemployment, then that raises questions about where interest rates will go, where bond yields will go, and whether investors are actually going to be well served with a lot of the conventional 60-40 type strategies that they've relied on in the past.
Jared, talk to me about bonds. We have been in the last few months in a pretty tight trading range of 50 to 70 basis points. Does this Powell shift take us up into a 75, 80, 85 basis point range now on the 10-year?
Well, you're seeing the 10-year move up this morning, as you mentioned. There's no doubt that the Fed, I think, wants
more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has coming here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
house. GVancetti.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949, in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay. In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low. And America played down Russia's influence, with Obama calling Russia
a regional power.
Despite all of that, Putin's approval rating remained sky high. And then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea, and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC come to China, come to us, say, 24 people went for the job. 23 people accepted. I was the only one guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word, beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你们早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River, whereas eBay is a shark in the ocean. And if they fight eBay in the ocean, then they'll lose. But if they fight them in the Yangtze River, then they have a home base advantage.
In 2007, just 1 year after it forced eBay out of China, Alibaba debuted its business-facing division on the Hong Kong Stock Exchange. But it delisted 5 years later as its performance sagged. But in 2014, Alibaba raised $25 billion in the world's biggest IPO in New York.
Everybody should have a dream. What if that dream comes true?
After achieving dominance in the business of e-commerce in China, Alibaba has been building an internet empire worth $472 billion, with businesses in cloud computing, online video streaming, movie production, healthcare, sports, retail, and even news media.
Alibaba buying into South China Morning Post really raised eyebrows. This is the largest English newspaper in Hong Kong, and it shows that Jack Ma's ambitions weren't limited to e-commerce. He wanted to influence not just Chinese users, but also overseas users as well.
The US has criticized Alibaba for allowing companies to sell counterfeit and poorly made goods, but in China, it enjoys the favor of China's government. It's part of Ma's company philosophy.
In love with the government, but don't marry with them.
Jack Ma is an extremely fortunate man for jumping on the internet sector so early. Note that this is a person who has no coding skills at all. He's a natural showman and a gifted public speaker, and really able to convince others to believe in his vision.
Ma's vision of growing Alibaba to be the world's 5th largest economy faces strong competition at home and abroad. It will require more than just naked ambition and charisma, but Ma is great at getting himself in the right place at the right time. So far, it served him well.
Peter Thiel is a walking contradiction. He got his bachelor's and Juris Doctorate from Stanford, but speaks out about the horrors of higher education, saying college is
as corrupt as the Catholic Church was 500 years ago.
He's a staunch supporter of the free press, yet he bankrolled a lawsuit to bankrupt an independent media company.
But these were not journalists.
And most of all, he's an immigrant libertarian who's the most public supporter of Donald Trump in all of Silicon Valley.
What Trump represents isn't crazy, and it's not going away.
This is the story of how an openly gay, immigrant genius, libertarian billionaire went from tech contrarian to Silicon Valley's biggest Trump supporter. Peter Thiel was born on October 11, 1967 in Frankfurt, West Germany, to Suzanne and Klaus Thiel. Peter's family emigrated to Cleveland, Ohio when he was 1. An Ayn Rand devotee during his youth, Thiel attended Stanford University majoring in philosophy.
His Stanford experience shaped a really big part of who he decided to surround himself with.
That's Lizette Chapman.
And I cover technology and venture capital here at Bloomberg.
He and his Stanford friends made their first big splash in tech with PayPal. After selling to eBay for $1.5 billion, they would become known as the PayPal Mafia for each incredible success after PayPal. For Thiel, that began with an early, modest $500,000 investment in Facebook.
And in VC speak, early means big risk, but also big reward. He turned that initial $500,000 investment into more than $1 billion in cash.
But Thiel was just getting started with Facebook, and he went on to make a whole bunch of wildly successful investments.
From SpaceX to Airbnb to one of the largest, most powerful companies in the United States, if not the world, and of course that's Palantir.
The incredibly controversial secretive data mining startup he founded with his colleagues from PayPal. It connects data silos and then allows non-technical people to search that information for patterns. Data like
financial information, feeds from video cameras, biometric details, passport information, flight manifest.
Palantir doesn't talk much about how they collect this data, who has access to it, or what they do with it. But they have contracts with
the Department of Homeland Security and the CIA and the Department of Justice and the Securities and Exchange Commission
and several other federal agencies. It's the richest company you've never heard of, valued at $20 billion. But there are plenty of obscenely wealthy people in Silicon Valley. What makes him different...
He's a complex ball of multiple contradictions.
Take college, for example. Even though college was extremely important for Thiel, there's something called the Thiel Fellowship.
In exchange for dropping out and a promise not to pursue college, Thiel would give them $100,000 each.
You basically tell people that if you get a diploma, you're saved. Otherwise you go to hell. You go to Yale or you go to jail.
Also, his relationship with the press.
Here's another contradiction. He's donated to free press initiatives, including the Committee to Protect Journalists.
But he also secretly spent tens of millions of dollars bankrolling a lawsuit filed by Hulk Hogan over the publication of a sex tape and bankrupting the independently run Gawker Media. Why did he do this? Because in 2007, one of Gawker Media's blogs, Value-Ag, outed him as gay. And with the lawsuit, he
found an opportunity to get back at them by funding the lawsuit that Hulk Hogan was able to bring then, but he wouldn't have been able to do that without Thiel's money.
And finally, Thiel's biggest contradiction, his endorsement of Donald Trump.
When he was asked about his support for Trump, he was surprised at the outrage that came with it from many of his colleagues in Silicon Valley. He didn't want more of the establishment.
No matter how crazy this election seems, it is less crazy than the condition of our country.
After briefly supporting Carly Fiorina in the primaries, Thiel pivoted to Trump, donating $1.25 million to Trump and his associated super PACs in October 2016. And he didn't just help Trump financially. He gave a full-throated keynote speech supporting Trump at the Republican National Convention.
I'm not a politician, but neither is Donald Trump. He is a builder, and it's time to rebuild America.
And when Trump was finally elected, Thiel was given the reins to an enormous amount of power.
And I want to thank you, man. You have a very special guy.
He was named the transitional advisor. And in that role, he did a lot of interviewing and a lot of vetting to fill hundreds of cabinet positions and different jobs within the administration.
But it turns out Thiel's support isn't unconditional.
Talking to people who spend time with him, I have also heard that he is no longer a great supporter of Trump.
It was reported that Thiel was unhappy with the direction of Trump's presidency. Ever since, he's been mum, making no public appearances, no statements, and staying out of the spotlight altogether. Although there have been suggestions that Trump could tap Thiel for a top intelligence post or ambassadorship, there's no indication he'd accept.
He's described his relationship with politics as schizophrenic. He gets really involved, and then he runs away as fast as possible.
Whether Thiel takes a new position or simply continues as a board director at Facebook and Palantir, at just 50 years old, he's primed to wield some serious influence in technology and politics for decades to come.
Two 2016 was again the hottest year on record, and the previous 17 years have seen our 16 most scorching. Scientists overwhelmingly agree. Global warming is the culprit. And it's just getting started. Ice caps, extreme weather, wildfires, droughts, and the hits keep coming. What are we doing about it? In 2015, the world took its boldest step yet to stem climate change with a historic accord in Paris. But now comes the hard part. Nations must change energy policies and invest huge amounts of money, and they will likely do it without the United States. President Donald Trump announced on June 1st that the U.S. would withdraw from the accord.
The reality is that withdrawing is in America's economic interest and won't matter much to the climate.
Here's the situation. Decades in the making, the Paris Agreement united the U.S., China, and more than 190 other nations in a push to limit fossil fuel pollution. The The UN-sponsored plan secured pledges to cut greenhouse gases, the emissions that trap heat in the Earth's atmosphere, in an effort to avoid the rising seas and other environmental disasters that climate models predict. But even if all pledges are met, the globe is expected to warm by as much as 3.4 degrees Celsius this century, more than the UN target of well below 2 degrees. Meeting the Paris Agreement means that governments will have to offer more incentives for clean energy, scale back support for fossil fuels, make emissions more costly, and reduce deforestation. It's estimated that the deal will require $13.5 trillion of spending through 2030. Here's the argument. Unlike past climate pacts such as the Kyoto Protocol, each country set its own Paris targets and then promised to revisit and improve them. The U.S. was primed to play a lead role in climate change, but Trump's Energy Independence Executive Order reverses Obama-era rules and directives put in place to combat climate change, and expands production of coal, the dirtiest fossil fuel. The resulting policies threaten the global fight against climate change. Without the U.S. commitment to emissions reduction, other countries may join it in abandoning the Paris Agreement. This could make it almost impossible and even more expensive down the line to stop climate change. Optimists argue that the shift to a lower carbon future is already underway. Businesses, cities, and U.S. states, such as California, are already investing in wind and solar and taking other steps to make it work.
I've actually been called an environmentalist, if you can believe that.